Hi student, we are studying accounting principles. Today we are studying chapter 4, the recording process. After studying this chapter, you should be able to the first explain what account is and how it helps in recording process. Second, define debits and credits and explain their use in recording business transactions. Identify the basic steps in the recording process. Explain what a journal and how it helps in the recording process. Also explain what a ledger is and how it helps in recording process. And the last, prepare a trial balance and explain its purposes. The first, what is an account? An account is an individual accounting record of increase and decrease in a specific asset, liability, equity, revenue, or expenses item. For example, Shopbite. Do you know the company we discussed in chapter 2? Shopbite could have a separate accounts such as cash account, accounts receivable, accounts payable, or service revenue. And a simplified format of accounts is T account. As you can see, in its simplest form, an account consists of three parts. The first, title of the account or account name. Second, debit side. And the third, credit side. Debit indicates left and credit indicates right. Debit is abbreviated as DR. Credit is abbreviated as CR. They do not mean increase or decrease as commonly though. We use the terms debit and credit to describe where entries are made in recording process, where accountants record transactions. And T accounts include the beginning and ending balances of accounts. T accounts also show the increase or decrease of accounts over the period. In this slide, we explain more about debits and credits. Again, they are the terms used in recording process. Debit indicates left and credit indicates right. They don't mean increase or decrease. Entering an amount on the left side of an account is called debiting the account. Making an entry on the right side is crediting the account. The account balance is the differences between the sum of its debits and the sum of its credits. If the total of debit amounts exceeds credits, an account shows a debit balance. An account shows a credit balance if the credit amounts exceeds the debits. Now, account classification. Why we have to classify the account? It's important to indicate that a subject is an asset or a liability or owner's equity because each subject is recorded according to separate rules. So we need to classify the account of the company. As you can see, there are three main kinds of accounts: assets, liabilities and owner's equity, and temporary accounts. Account assets include current assets and long-term assets. Accounts liabilities and owner's equity divided into two small groups: liabilities and owner's equity. Temporary accounts, we have three kinds of accounts: revenues, expenses, and income summary. Now, open the chart of account. We will classify these accounts together. I email for you the chart of account. You need to print them. Here is a patch of charts of accounts I email for you. Now, In a asset account, we have a cash account, accounts receivable, inventory accounts, buildings, equipment, or land. This is fixed assets account, or accumulated depreciation accounts and other accounts. Liabilities accounts, such as accounts payable, not payable, unearned service revenue. Unearned service revenue is a special account. I study this account later. Owners and stockholders equity. We have owners capital account, owners drawing account, and owners drawing also special accounts. Revenues. We have sales revenue or service revenue or sale returns and allowance. And expense accounts consist of cost of goods sold, salaries and wages expenses, selling expenses, advertising expenses, and other expense accounts. Remember, it's very important to indicate that a subject is assets or liabilities, revenues or expenses, because each subject is recorded according to separate rules. Accounts assets, liabilities, and owner's capital. They are called balance sheet accounts as considered permanent accounts because they carry their end of period balances into next accounting period. In contrast, revenue and expense accounts and owner's drawing are considered temporary accounts or nominal accounts because these accounts are closed because they begin each accounting period with a zero balance. Remember, zero balance. Accumulated a balance during the period and then clear by means of closing entries. Closing entry is very difficult and related to accounts income summary. We need to read the book that I sent you to understand this section. One of the duties of accountants is to record financial transactions, and double entry system serves for accounting record. Now, recall chapter 1. We learn the effect of a transaction on the basic accounting equation. Under double entry system, each transaction must affect two or more accounts to keep the basic accounting equation in balance. For example, the company purchased goods and paid by cash. You see, in this transaction, we have two subjects or two accounts are affected. They are goods and cash. Purchase goods, sold goods, increase. The company paid cash for seller. It means that cash of the company decrease. So an asset increase, another asset decrease with the same total, and the basic accounting equation remain, okay? And under double entry system, we debit at least one account and credit another account. It means that in each transaction, accountants can debit all accounts or credit all accounts. They must debit at least one account and credit another. For example, goods, we debit goods and we credit cash. We not debit goods, debit cash, or not credit goods, credit cash. Okay? In other words, for each transaction, debits must equal credits in the accounts. As a result, the sum of all the debits to accounts must be equal the sum of all the credits. All of this is to keep the basic accounting equation in balance. So double entry system very important in the recording process. In double entry system, the problem is that How to identify which account is debited and which account is credited? It depends on the rules of debit and credit. As I said before, each account group is recorded according to separate rules, and this is tier count of assets and expenses account. As shown, assets and expenses accounts follow the same set of debit credit rules, and you see, debit or DR always indicates the left, and credit or CR always indicates the right. Normal balance includes beginning and ending balance are shown in debit side. Here, show in debit side. When financial transactions make assets or expenses increase, the entry is debit. It means that assets expenses increase. We debit assets, debit expenses. In contrast, when financial transactions make assets or expenses decrease, the entry is credit. Yes. Here, it means that assets expenses decrease. We credit assets, credit expenses. And what is beginning balance or ending balance? Beginning balance is from end of prior period. The sum of increase and the sum of decrease are recorded and calculated during the period. So we have to calculate ending balance as follows. Ending balance must equal beginning balance plus the sum of increase and minus the sum of decrease. Now summary. Debits increase assets and expenses accounts. Credits decrease the accounts. And assets expenses accounts normally carry a debit balance, or normal balance is in debit side. For example, this is tier count of cash accounts. This tier count shows us that at the beginning of the period, cash has a debit balance of $600. Then, during the period, cash was debited for a total of $750. The sum of $250 and $500, and credited for a total of $500. The sum of $200 and $300. As a result, cash has a debit balance of $850 at the end of the period. 600 plus 750 minus 500 is $850. This is ending balance of cash account, and this is tier count of cash. An asset account, you see, ending balance and beginning balance or normal balance is in debit side. And when cash increase, we debit cash. When cash decrease, we credit cash. Okay? This is tier count of liabilities and revenues account. As you can see, liabilities and revenues accounts follow the same set of debit or credit rules. Normal balance includes beginning and ending balance as shown in credit side. When financial transactions make liabilities or revenues increase, the entry is credit. In contrast, when financial transactions make liabilities or revenues decrease, the entry is debit. Okay? And ending balance is calculated in the same way of assets or expenses. And as you can see, Normal balance and increase always in the same side and decrease in different sides. Okay. In this slide, we study about owner's equity account. In owner's equity account group, we have two most popular accounts. They are owner's capital and owner's drawing. As you can see, although they are in the same group, but they are recorded in different ways. Owner's capital is recorded in the way or according to the rule of liabilities, but owner's drawing is recorded according to the rule of assets or expenses. Remember these rules. The rules of assets, liabilities, revenues or expenses or owner's equity very important in double entry system as well as in recording process. Now, to apply double entry system and the rule of these accounts we have just studied, we have a small exercise. Here is 5 financial transactions. The first, the company paid for advertising programs by cash, $2,000. Second, provided services to customers on account, $5,000. The third, paid salaries of $3,000 in cash. The fourth, purchased inventory on account, $2,500. And the last transaction, an owner withdrew cash for personal use, $1,000. The duty is making entries for this transaction. Remember, you need to apply the rule of debit or credit of the account we have just studied in previous chapter. I think before I give answer for this exercise, you have 5 to 10 minutes for preparing. The first, paid for advertising programs by cash, $2,000. To make entry for this transaction or to record this transaction, we identify which accounts are affected by this transaction. Now, which accounts are affected? We paid for advertising programs by cash. Yes, of course, cash accounts. Cash accounts affected and particularly cash increase or decrease. We paid cash for seller. It means that cash decrease. Cash decrease. And another account affected is advertising expenses. Advertising expenses increase or decrease. Company paid for advertising program, so advertising expenses increase. Advertising expenses increase. Now, we apply the rules of debit and credit. Cash, it means assets accounts. According to tier counts of assets accounts, assets decrease. It means credit or we credit cash. On the other hand, expenses, when expenses increase, we debit expenses. Okay, and the final answer is debit advertising expenses and credit cash, $2,000. Do you understand? The next transaction, provide the services to customers on account, $5,000. Provide the services to customer on account. It means that the company provides services, but customer they didn't pay cash immediately. Customer will pay cash later in the future. Okay, so which accounts are affected by this transaction? When customer pay in the future, it means that Accounts receivable. Accounts receivable affected, particularly accounts receivable increase. Accounts receivable increase. And company provides services to customer, they earn money, so service revenue, revenue or service revenue increase or decrease. Service revenue increase. Now, accounts receivable we classify as asset account. Assets increase, it means debit. And revenue increase, it means credits. The final answer is debit accounts receivable and credit service revenue $5,000. The third transaction, paid salaries of $3,000 in cash. Very easy. Cash is asset and paid cash, it means cash decrease. Paid salary for employee, so salary expenses increase. You see, assets decrease, we credit assets. Expenses increase, it means debit salary expenses. And the answer is debit salaries expenses, credit cash $3,000. The next transaction, the company purchase inventory on credit. Purchase on credit, it means purchase on account. Company purchase, but company didn't pay for seller immediately. They will pay in future. So we pay in the future, so accounts payable, okay. Accounts payable affected, particularly accounts payable increase. And inventory, we purchase inventory, so inventory increase. Inventory as asset increase, we debit inventory. Accounts payable classified as liabilities, so when liabilities increase, we credit accounts payable. And the entry is debit inventory, credit accounts payable $2,500. And the last transaction is an owner withdrew cash for personal use $1,000. This transaction is quite difficult. Why? Here we have a special account in this transaction. Owners withdrew cash. Of course, cash affected, and when owner withdrew cash decrease. Cash is asset. When asset decrease, we credit cash. And another subject affected by this transaction is owner's drawing. Yes, we have a special account to record when owner withdrew cash. Is owner's drawings. And owner withdrew cash, it means owner drawings increase. Because owner's drawing is recorded in the rules of assets, so when owner's drawing increase, we debit owner's drawing. And the final answer is debit owner's drawings, credit cash $1,000. I think it's enough today. And remember, chapter 4 is very important, and you need to understand the rule of debit or credit side applied for assets or revenue, liabilities or expenses, and understand how to make entry for financial transaction. Thank you for your attention.